Federal Reserve leaving rates unchanged at 5.25% to 5.5%, but making big changes to the statement. The statement twice mentions the possibility of changing the funds rate, setting out the circumstances for those rate cuts that maybe are nebulous, but maybe even a bit hawkish, depends on where you come from. I want to read you the statement that says here, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. It later says inflation has eased, but that it remains elevated. So it's saying the committee will only cut rates when it's confident inflation is moving to the 2% target. No mention in the statement of whether it has that confidence. The statement also says, quote, in considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee removed that bias that was in there for hiking, where it talked about additional firming. That's no longer in the statement. The risks to achieving its dual mandate, the Fed says, quote, are moving into better balance. On the economy, there was an upgrade saying it's expanding at a solid pace. Had said it was slowing in the prior statement. Job gains, it says, has moderated but remains strong. And it removed a section on concerns about the impact of tightening credit conditions. That's gone from the statement. It also removed a section on accounting for prior tightening and monetary lags. It was a unanimous decision with new voters Barkin, Daly, and Bostic and Mester voting as well. So cuts, guys, are obviously in play, but the Fed at best is not telegraphing any timing around it or amount. And you could be ready to suggest those cuts may come later than the markets now expect.
So let's talk about this market reaction. And we referenced this at the top. It was almost like, why are you so surprised? And yet here we are. So if we're offsides when it comes to now Powell shutting the door on a March cut, how offsides are we going to be later on when the Fed doesn't cut 50 basis points?
We're looking at through the lens of the Fed announcement or the commentary caused the market. I guess you could, but, you know, the VIX was elevated long before the Fed presser today, right, or Fed announcement, which we've had that conversation on our call. And I think the market was looking for an excuse. And we talked about earnings last night. So you could absolutely cast blame on this Fed presser today and all the commentary out of it. I would submit to your earlier point, it shouldn't be a surprise, and maybe there's something else going on right now.
What do you think, Michael? What great minds at Richard Bernstein Advisors say about this market move?
You know, let's put aside the market move for a second. I think it was completely irrational for the market to be pricing in such a high odds of a cut in March. So that certainly did not surprise us at all. I still think it's completely irrational that the market's pricing in 6 cuts till the end of the year. I mean, that just doesn't seem to make a lot of sense to us whatsoever. The way that I look at it is, what's the higher probability? Right, with GDP humming at 5% in Q3, 3% in Q4, you know, the consumer's still strong, profit growth accelerating, that we're in recession that causes the Fed to cut, 6 times, or that maybe inflation stagnates. And I think that's what Powell told us today. The higher probability is that inflation hangs out in that sort of 3% range, not that we're headed to recession. And the markets maybe haven't really woken up to that yet,
Well, to me, the move of the day is the bond market. The move is the 10-year. And if you look at a 1.2 point rally in the 10-year, that's not an environment where the economy is a little stronger and where the Fed is Fed has essentially upgraded the economy and things are okay. We're pushing it down the road a little bit because we'd rather risk waiting a little bit longer. That's a market that's doing 2 things. First of all, I think some portion of that is New York Community Bank, and we're going to talk about that. But some major part of that is the Fed is actually going to wait way too long and push this thing over the hill. And that's really fascinating. On it, and over the hill meaning, recession and be, and actually put too much republic. The lower inflation goes and the more Fed funds stay at these levels. Everybody knows this, but I'll say it clearly. It becomes much more restrictive, right? And there's a dynamic here that people are concerned that the Fed, what they told you today, the 2 things I heard, and we just said it, the labor market's too tight, and we're not at our inflation target. They couldn't have been clearer about that. So the bond market, to me, says that Fed is not even close to doing what we want. It's not that equities have a bad backdrop here. It's that equities, the S&P's rallied 20% since October 26th, and we've had a great start to the year, and everybody thought the Fed was not going to be a factor.
It seems like for a while now, we have assumed that the long and variable lag effects of the rate hikes have come and gone. But today, he really opened the door to, policy is you'll continue to feel it as the year goes on. So that's still the wild card here, or a wild card at least.
One thing I thought was odd, I think that bonds were
By the way,
moving.
congrats for having the best question.
Oh, thank you.
No.
It's usually how it goes. It's usually how it goes around here, by the way.
you.
It's always Karen, but anyway.
Well, so the bonds had already moved yields lower, bonds higher before this came out. So half of that move already happened, right? So I don't know that this, what seems like a big move in the bond market, is actually that big. I'm not quite sure. I agree with you that we were set up for some kind of pullback. The market strength over the last month has been, to me, quite surprising. You know, and then last night you had earnings that were good to very good that were met with kind of ho-hum, right? You got to show us something new. And so it's not surprising that we would have this, what should have been even a bigger sell-off in the triple Qs. I mean, they were off a lot, but if you think about how far they've come, I don't know, sometimes it might not be this particular thing that caused the sell-off, but we were absolutely due for some. And if this is all there is, I'd be surprised. I would think the bar is still high for earnings the rest of the week.